Hi everyone, Billy here, the co-founder of Trade Prosper, and welcome to section 12, video 3. This is the last video of the option section that we'll be covering, and we will finish up with the stock replacement strategy and how it can be used when trend trading. In our last video, we looked at which strike to choose when doing a stock replacement strategy, and also the significance of the option's strike price, or rather the sensitivity of that strike price, in relation to the spot movements that we see in the underlying instrument. We did so by using an example of a trend trading technique that produced a signal for us to go long some shares. And we showed how by buying a deep in the money call option, struck at $34, we will be able to ride this anticipated trend after only having spent $330. Now this was to control 100 shares, which if we bought it outright would have cost much more. So now that we're in the trade, let's evaluate two possible outcomes. Reminder that originally this analysis that we've done has indicated a signal for us to go long the shares at 36.64, and at that point already we know that the stop loss we're going to adhere to is 35.85. So let's now view what will happen when the share price goes up, and also let's view what will happen when the share price goes down the other direction. So in other words, the trend didn't materialize the way we thought it would. So when evaluating the share price going up, let's say it goes up to $50 a share. We have to consider the following two scenarios. Remember, we're entering this trade via the options route, and an option has got an expiration date. So we're going to have to look at this movement in two ways. One, that the movement happened while there was still some time left on the option itself. So the share price moved up to $50. We now have an exit indicator on our trend trading strategy, and we now wish to exit the trade up here. The option itself has not yet reached its expiration date, so there was some time left on the option. And the second example we're going to look at is, what if we reach the option's expiration date before we wish to exit the trade naturally? So in other words, we didn't get a trend signal that says we have to exit here, but we're at the end of the expiration time, or the time available for the option itself. So we're going to look at those two strategies going forward. The strategy, we need to remember, emulates the move of the underlying shares by a tune of 78.6%. Now, I have to mention something here. Again, this is not to confuse you, but rather in an effort to be extremely thorough in the explanation. The option delta itself does not remain static. Actually, it changes quite a bit over time, but we don't really have to worry too much about this in an example where the share price increases from here. We really only care when the delta starts dropping. So for now though, let's just realize that by the time the option reaches its maturity date, the delta will reflect the full value of whatever spot is then, and the difference between that and your strike rate of the option. So even though we have some time left on this example, we're just going to pretend that the delta remains unchanged as the 78.6 that we originally started off with. So let's look at example 1. We get an exit signal before the option has reached its expiration date. So with the actual spot being up at 50 now, we can close the position by selling the call option back into the market. And we can estimate the option's price movements as follows. Remember, we bought the option for $330, and this was back when the spot rate itself was at $36.64. And starting from there, the spot itself moved up by $13.36 to reach $50. So if you look at our option, which had a delta of 78.6, in other words, it reflects the underlying spot movement to the tune of 78.6%, if the spot moved by $13.36, we can assume that our option's price itself would move by $10.50. Or stated differently, the option at that point in time would be worth roughly $13.80. And we got that by saying the initial price was $3.30, and that from there, the spot moved up, and our option delta reflects a diluted percentage of that spot to the tune of $10.47. So by selling the option back at that point, we would have banked a profit of roughly $10.47. So let's now compare that to a position in the actual physical shares itself. In other words, buying 100 shares at $36.64, and then selling them at the current market level of $50. If we had done that, we would have made a profit of $13.36. So yes, when comparing this $13.36 to the option profit, we've made a little bit less on the option. But remember, for the option, we only had to put down $330, where otherwise buying the shares outright would have cost us $3,664. So though the absolute number of profit might be a little bit less, the return on invested capital is much, much higher. So once again, this shows you the power of options and the leverage that they can provide you to your overall portfolio. Let's look at example number 2. This is the case where we exit the position at the option's expiration date. In other words, the option period is now over. Now remember, when we get to this point, there's two conditions that holds. We might actually want to close the option outright and just get out of the trade completely. But quite often, being in a trend and the trend's moving quite nicely, you sometimes don't really want to close the position then. So what would you do if your option expires and you still want to be back in the trend? So we'll look at both those scenarios. So if we wanted to end the trade here, in other words, just sell the option back, the amount of profit that we would have at this point is calculated as follows. Buying the shares at 34, selling them at 50 creates a profit of $16, but we paid $330 worth of premium, so that leaves us with a net profit of $12.70. But quite often what happens is when the trend is very strong, and we wouldn't normally exit the position here, when we end up at a maturity date of the option, we have a choice to make. We can either just close the option, as I said, or alternatively, we just roll the option into the underlying instrument itself. So we would do that by literally just exercising the option and buying the shares at $34. By doing so, we are now effectively long the actual physical shares and can continue onwards with the trend. And now remember, once we're in the shares itself, we are back into the trend. From here, we will follow all the exit strategies that Mike has shown you to decide when to get out of the trade from here. But what would happen if the stock went the other way? So let's say we get stopped out at our level of $35.85. Remember, that's a stop loss we've loaded right at the onset. In this example, we can safely assume that the stop level was triggered before the option expiration date. So we only have one calculation to do here. A reminder, the share price was at $36.64 when we started, and the option premium we spent at that point was $330, and that allowed us to control 100 shares. So looking at the actual underlying trade, when the price dropped to the stop loss level, if we held the physical shares, which we bought at $36.64, we now sell that at the stop level of $35.85, that will equate to a loss of 79 cents per share. Or in other words, for 100 shares, $79. Now remember, the exact calculations done here excluded the fact that we would have added a cushion to the entry and exit levels. You will recall that our risk calculator already assumes these cushions. So even though we physically calculated the loss here as $79, once we take the cushions into account, your real loss will be closer to $100 in this example. So what would this look like for our option strategy? Remember, in this case, we sell the option back into the market at the time that our stop loss is triggered. So we're going to get some premium back. Even though we paid $330 for it, something will come back towards us. Because remember, that option still has value. We're assuming there's some time left between that specific point and the option expiration. So having worked out that the share price itself moved lower by 79 cents, and then you remember that our option delta only reflects 78% of that move, our option price itself would have only dropped by around about $62. So when selling back this option, we'll get back somewhere around $267 back from the original $330 spent. So two things to note at this point. This strategy should have a smaller loss on the way down if we use the same original risk measures. And the reason, therefore, is just the delta effect. In other words, the option mimics the price by a lesser extent. Okay, so the same way on the way up, we don't bank the full profit. Same way on the way down, we typically won't bank the exact same loss. However, there's something to look out for, and this is the time between us entering the trade and how long it took to get us to this price where we are actually stopped out. You have to be aware of a time aspect that's inherent in this strategy too. A second thing to note is that, remember I mentioned that for this specific example, we'll not be looking at the option premium itself and measure that premium against the 1% risk matrix, like we did in the put example we did it in section 11. And now you see why. We never really risked the premium completely. We risked a portion of the premium. And the portion that we risked was to the tune that it was in line with our risk that we were willing to take. So in other words, it doesn't really matter what we spend on the premium to start off with. What we are worrying about here is just to ensure that we don't get less back when we sell the option, that the loss is more than the 1% risk parameter that you're looking at. This officially is also the last video of my part in this course. And I do want to invite you, if you really like what you've seen, please feel free in joining us in one of our other courses that goes into a little bit more detail about these things, or alternatively jump on one of our webinars, or hopefully we'll even see you at one of our live events soon. I want to thank you for your time, and I definitely want to congratulate you for having gone this far through the course. By now you've learned a ton of stuff that you can apply immediately to your trading strategies, and as Mike said, you're now part of the Trade Prosper family, so we look forward to working with you. This is Billy from Trade Prosper, and thank you again for joining us. Bye-bye.